Hey everybody, and welcome to our new series, Methods of Modern Finance. I'm so excited for our workshop today. We're talking about microloans, and specifically Utah Microloans with Brandon Orr today. And we are here at the Small Business Development Center here in Blanding, but we also have our Small Business Development Center in Price and our Small Business Development Center in Moab joining us. And so we're the Eastern region is definitely taking on a bigger role in some of this information that we're starting to share as we develop businesses and get back on track after COVID. I'm really excited to bring Brandon into, I can't say into the center today, but we bring Brandon on today. When we had the SBA here last month, one of the things that came up was business loans for smaller businesses that don't need these really, really big loans, that just need the smaller loans that might be a few $1,000s all the way up to maybe 15,000, 25,000. Those smaller loans that maybe the banks don't really look at or discourage. So that's why I'm really excited to have Brandon. I actually had him on the schedule beforehand, so it just kind of lined up perfectly. But I'm going to turn the time over to Brandon. I want to thank our cooperative agreement with the U.S. Small Business Administration that helps fund these classes, as well as Utah State University. I'll turn the time over to Brandon now.
Great, thanks, Megan. Glad to be a part of this. I think it was about 8 years ago, I was actually an intern for the Small Business Development Center in Tooele on the west side of the state. So I have a special place in my heart, and I'm glad to be here. So we're going to talk a little bit about financing small businesses today. I'm going to talk about a couple different ways that you can do it. You know, it's never one size fits all. And so I'm hoping we can have a discussion to help you understand a little bit more about what would be the best fit for you. So I'm going to share my screen. This usually takes about 5 minutes because I'm not very quick at it. All right. Are you able to see my presentation? Or are you looking at my email?
Nope, we can see your presentation.
Perfect. All right. Great. Let me get it going. Okay. So as mentioned, I am part of Utah Microloan Fund. We are an organization, a nonprofit here in Utah. We are actually the only SBA micro lender in the state. And our mission is to empower underserved communities throughout Utah by providing business training and funding to entrepreneurs in startup and existing businesses that do not qualify for traditional funding sources. So really our main focus is the funding side. We definitely like to refer people to the small business development centers for business plan creation and cash flow projections and things like that, because that's what they're good at. So we want to try and help people who aren't able to get bank loans. So let's talk about money. Benjamin Franklin said, if you would know the value of money, go and try to borrow some. I don't know about any of you, but I was running a small business probably 10 years ago, and I was trying to get a loan so that I could grow the business, and I got rejected a few times. I was just a little bit too high risk for a traditional bank, and I wasn't able to get the financing that I needed. So I wasn't able to grow the business the way that I wanted to, which was definitely a challenge. Money is hard to come by, and money is the lifeblood of the business. More specifically, cash is the lifeblood of the business. And one of the challenges with cash is a lot of times you have to have the cash before you can start the business or grow the business and earn the cash. It's really counterproductive. So we want to try and have the money so that we can spend the money so that we can earn the money. And that's really a difficult position to be in. So we're going to talk a little bit about business funding options. Obviously, it would be great if the business would instantly start earning money that we could turn around and put back into the business, but that's not the case. Sometimes we can start businesses on less than we would like to have, and other times we need cash. So normally I open the mic, I open the board to get some feedback on different business funding options. I'm not sure how accessible microphones are, so I'm just going to jump into this. But if anyone does have any comments or any questions, please don't hesitate to interrupt me. So let's talk about some business funding options. There are actually a lot. The first one is the 3Fs, family, friends, and fools. Banks provide funding. Sometimes investors are interested in businesses. Bootstrapping, which we'll talk about each one of these, but credit cards, online lenders, crowdfunders, and then micro lenders like us. So we're going to jump into each one of these, and we're going to talk about the pros and cons of each one. So first one, family, friends, and fools. Pros and cons. So I think sometimes this is the first place that we go, and sometimes this is the place that we don't necessarily want to go. Oh, hey, no, I can't. Can you go out? I'm in a meeting. Sorry, got a little helper here. All right, let's talk about family, friends, and fools. So one of the pros of getting money from family, friends, and fools is there's less paperwork. A lot of times you can do it on a handshake, which isn't necessarily the best way to do things. Fewer requirements. A lot of times you can negotiate something fairly straightforward. The interest rate is often less. Sometimes it isn't, depending on how nice and available funds are to your family, friends, and other people. And then other lender benefits, basically they benefit from it if they have cash laying around or that they'd like to do something with and make some money. The cons are friends are forever until you let them borrow money from you. I've had this experience and I've seen this experience in my life where anytime you start to mix business with family, it can get a little bit difficult because there are definitely challenges and struggles, and sometimes it's best if things don't mix. My wife worked in a small business with me for a little while, and that was not a good thing for our relationship. So we haven't done it since, but it's an option. So this is option number one. It's tough on relationships. Sometimes there's a lack of clarity. So if you've partnered with a business or with a family member and they have ownership in the company and you decide, I just like to buy them out, or maybe this isn't a good partnership. If there isn't clarity, if there isn't an understanding, then that can create some issues as well. So family, friends, and fools might be an easy way, but there are definitely some cons to it. Banks. Now, we talked about this a little bit. One of the pros of banks is they often have lower interest rates than other organizations, including ours. There's a predictable monthly payment. That's the nice thing about a bank, is you can just know exactly what the payments are going to be like, what the interest rate's going to be like. It's very structured. This is something that helps you build your credit, which could qualify you for more financing in the future. And it creates a relationship with the banker. This is something that I think is overlooked a lot. Bankers have a certain knowledge of finances when it comes to small businesses, and creating a relationship with them is very advantageous because it can help you to grow your business long term. And then there are some great programs. So it sounds like the SBA came out and talked a little bit about their programs, the 504 program, 7A. So we won't really jump into that, but there are some good programs that you can work through with the bank. Okay, the cons. Sometimes there's a lot of paperwork. Filling out applications can feel daunting and be difficult. Sometimes there's a longer wait time. It takes a little bit, especially right now with them rolling out all of the PPP loans. They're extremely busy, and so you may not be able to get the funding as quick as you would like it. A lot of times it requires strong credit, it requires collateral, and more often than not, a business wants to see 2 years of business history, which it puts you in a tough spot if you're trying to start a business and you don't have that history. So this is not, like I said, a one size fits all. It is a good option for a lot of people, but for those of us who weren't able or aren't able to get the bank financing, we have to look at other options. So let's look at investors. I think sometimes we think, hey, let's just go find someone who's going to give us money. And one of the challenges with that, well, we'll talk about that in a minute, actually. So investors a lot of times don't mind if it's a startup. It's not a big deal, especially if they see the opportunity that's out there. They don't necessarily require a strong credit history. They may not look at your credit history at all. And there are no monthly payments. An investor relationship is where they put money into the business that ultimately stays in the business. And so there aren't payments that go out to them. One of the other pros is if you're bringing in an investor who partners with you in your business, sometimes they have additional experience that can be extremely beneficial to you and your organization. And I would say, don't ever bring in an investor if all they're bringing to the table is money. You want to have someone who has additional experience. Often there's no collateral needed. So let's talk about the cons. Less ownership. Now, this is kind of a double-edged sword and something that I think people frown at more often than they should. If your business is the type of business that an investor is looking at and considering investing in, sometimes it's worth it to own 50% or 70% of $1 million company versus owning 100% of a $100,000 company. And so if they're able to add value with what they're bringing in, sometimes giving up some of that ownership isn't necessarily a bad thing. But it also comes with less control. If someone else comes in and they don't have the same vision that you have about the business, it may be tough to go the direction that you'd like to go. And so you have less control. And then that creates a difference of opinions and then higher stakes. If there are other people involved who have money that they've invested in the business, it's a lot harder to feel like you can, if it doesn't work, you can pivot or do other things. It adds a lot of stress, I think, to the relationship and to how you are running the business. You want it to be successful. Now, a lot of times when it comes to investors, unless they're family or friends, investors are more looking for high, fast growth startups where they can put money in and they can get 10, 15, 20, 25% back within 5 or 10 years. And so if you're just growing a family business that you just want to grow and run and make a living off of, that's a great thing, but it might not be the best fit for investors. And so that's something to keep in mind as well. A lot of investors are looking for high growth with a higher return in the future. All right, bootstrapping. This is definitely a buzzword these days, and it's something that I think a lot of people are doing, and it's not necessarily a bad thing. So growing slower and just using your own money and the money that the business produces can definitely be a good direction to go. So the pros: ownership and control of your business. You're the one running it. You're not beholden to anybody, whether it's a bank or an investor or family, friends, or fools. So that's a good thing. The ability to pivot. So when you look at a lot of these tech startups that have gotten huge, the fact of the matter is the product that you see today is more often than not very different than what they initially created. And the nice thing about growing slowly is it makes you a little bit more flexible. It allows you to make adjustments. So let's say you're selling hot dogs and you wanted to open a food truck that made hot dogs and you weren't able to do it. If you started bootstrapping, maybe you started going to farmers markets and just selling it off of a table or something like that. And maybe you realized, hey, food trucks isn't necessarily the way that I should go. My market isn't looking for hot dogs. They're looking for corn dogs, or they're looking for something that requires different equipment. It allows you to take maybe a 90-degree turn to do something else that you otherwise wouldn't have done. I think a lot of times it feels like ideal would be, let's create the business exactly how we want it. But if we're growing slowly, it allows us to do more market research, figure out what our market wants, and make those adjustments at a lower cost than if we had already created a structure that was large and unwieldy. Lower risk. Oh, go ahead.
Yeah. On that same note, you think of everything we're going through right now and that ability to pivot. If you were in something that you couldn't have that ability to pivot, imagine when COVID hit and you couldn't pivot around COVID because you'd put yourself in such a position you didn't have that flexibility. So that's another advantage of that ability.
That's a great point.
Some of the businesses that did the best in 2020 use that ability to pivot and make changes and adjustments and went online versus stuck in a brick and mortar or whatever that might be during this time and did really well.
Perfect. Yeah. And we actually had someone apply for a loan who wants to open a salon. They do eyelash extensions and other things in the Salt Lake area. And one of the risks with that is if you get into a location where you're paying rent and you're in a contract for a lease, and then your esthetician gets COVID or gets exposed to COVID, they can shut you down for 2 weeks, and you still have to pay the bills, even if you're not bringing any money in or not able to open. And so growing smaller, especially in this economy, especially in these conditions, lowers the risk and maybe allows you to grow a little bit more conservatively and be stronger. So great point. Thanks, Megan. Okay, let's talk about some of the cons. Slower growth. Sometimes it's frustrating when things grow slowly. You want it to grow faster. And if you're looking at getting a first mover advantage in an industry or with an opportunity, this could definitely be a disadvantage, because if you're growing slower and you're limited, then someone else could kind of pull ahead potentially. There's always the risk of running out of cash. And like we already said, cash is the lifeblood of your business. And then an inability to take over market share. So if you're bootstrapping and you get some huge orders in, you may not actually be able to keep up with those orders if you don't have the cash. And so it could create some problems. Now, that's not necessarily a bad problem, but it's definitely a challenge. And then difficulty hiring. If you're not able to pay bills, you need someone to come in and do some work that could help you increase your sales, but you don't have the cash to pay them first, then, it's that chicken and the egg thing of, do we hire someone so we can make more money, or do we make more money so that we can hire someone? And that's a major challenge when it comes to bootstrapping a business. Okay, online lenders. I don't know if you've seen them, but I get bombarded with all of these people online, all these organizations online that are offering loans, Quicken loans, there's Cabbage loans, there's PayPal loans. They're all over the place. There are some very great benefits to these. A lot of these are super fast. They say, hey, we're not even going to check your credit score. You just give us your pay stubs or whatever it is, and we'll get you funding. And they can get you funds within 24 hours sometimes. A lot of times there's minimal paperwork required. You're able to get in, get the money quick and get out. And a lot of times they don't require collateral. Sometimes they'll look at your accounts receivable if you have a business that has receivables and lend you money based on that. But it's usually pretty straightforward and streamlined. Now, high fees and high interest rate is pretty synonymous in my mind with most online lenders. A lot of these guys are on par or above credit card percentages, where they're charging 20%, 30%, 35%. And this could really, really have a huge impact. Shorter terms, they want it paid back very quickly. It's very tough on cash flow. We've actually seen a lot of people come in with these loans. Hey, I have a Cabbage loan, and you look at their cash flow projections, and they're spending an extra $500,000, $700,000 a month on interest alone, and it's tying up their cash flow that they could be spending doing other things. And so they try to refinance those as quickly as possible. And then a lot of times they require a higher credit score. If they're going to take the risk, they're going to take it on people who have a good history. So I am very cautious about online lenders, because a lot of times the rates are horrific and it is extremely risky. And so I would be very careful with these. And credit cards. How many of us have started businesses with credit cards? The pros are they're fast to acquire. Man, it seems like when you get a certain age, everybody wants to give you their money, but then when you need it, you can't get it. So fast to acquire, no regulations on use. You can just spend it however you want it. It can build credit. There's no collateral needed, but this one comes at a cost too, just like those online lenders. High interest rates. Man, when you look at those, sometimes they'll get you in for 15 months at 0%, but then once you get past that, it's 18 to 22 or 24%. It's crazy, and it'll just eat you alive. Unlimited liability. If you can't pay on these, they can just keep taking and taking until they get what you owe them. And it can negatively impact your credit. And then just like the other online lenders, it can be tough on cash flow because of how much interest you're paying. And really, it's going to be expensive in the long term. I think you hear a lot of stories of people using credit cards to grow their business, and it can be done, but it's scary. I've heard stories of people who had lines of credit or credit cards where they're not paying interest until after the 25th. And so they would rack up the card and then they would pay it off. And then one day they would forget to pay it off. And 2 days later, they owe thousands of dollars of interest, and it threw their business off considerably. And so you need to be so careful with these. Okay, crowdfunding. How many of you guys have been on GoFundMe? Oh, shoot. It must be Wednesday. I can't even think of the other ones. Help me out, Megan.
Oh, I should know these too. I've got 3 businesses that are doing this right now, so yeah. I should know them.
All right, well, let's just talk about crowdfunding in general. So crowdfunding is cool because it allows you to do pre-sales a lot. It allows you to test the market. Like I said, get cash for pre-sales, create awareness and momentum. And a lot of times you don't have to pay it back. I've actually helped a number of former clients with crowdfunding, and there are some campaigns that do really well, but a lot of times it kind of has to be a specific business. If you have something that you can sell, pre-sell early on, then it could be a possibility. It's great because it allows people to actually know that you exist. You know, that's what a lot of marketing is telling people that you exist so that they know where you are, and where to go to buy whatever it is that you're selling. And then like it says, you know, you don't have to pay it back, which is awesome. Challenges are, you know, it doesn't work for many industries. If you're creating a welding company, or if you're creating a company that does accounting services or something like that, this might not be the thing for you. It requires a lot of preparation. Did I spell preparation wrong? Shoot, I think that's my typo for the day. So a lot of times people think we're just going to throw it up there, we're going to create a cool video, and it's just going to go and explode. But really, it's just a piece of the puzzle, and you have to be able to drive awareness, drive traffic to that campaign so that people can go there. Most people aren't just, you know, surfing these sites to be able to find cool things that they can buy. You really have to send people that direction. And along those same lines, there's a lot of marketing required for it. Sometimes you'll spend $1,000, $2,000 just to market the fact that you have this campaign going, so that the right people can get there and purchase what it is that you're selling. And that can be very expensive. So crowdfunding, I would say, if that's something you're interested in, talk to your SBDC counselor and see if it's a good fit. I would say most of them have done campaigns and helped people on campaigns in the past. So that's definitely something you can discuss with them and learn a little bit more about. Okay, let's get to my favorite slide, microloans. So there are pros, and unfortunately there are cons to microloans. So cool thing with microloans is they're pretty flexible. We're flexible in terms of our lending, and we are able to look at things a little bit differently than a bank. A lot of times there's less collateral required or no collateral required sometimes. We don't require any money down. I don't know if any of you have ever gone to a bank and they said, yeah, we want you to put 20% down, and you're like, I don't even have that 20%. We don't require that. We do have fees, usually about 5%, and we work that into our loan. There's not a lot of business. We don't require business history. So if you are a startup or in pre-startup mode, that's not something that's going to preclude you from getting any financing. And then, like other loans, this is something that can help you build credit. We do have a fixed interest rate, which is great. And then we do have a training and consultation portion on that. Especially if you've gotten a loan with us, we like to work with you to help you if you need help with cash flow projections or marketing. We have an in-house marketing consultant, and then I do a lot of financial consulting as well. So that's an option for you. So microloans are great. I'm going to talk a little bit more about the specifics, but basically we do up to $50,000. If it's above $25,000, we have a little bit more strict requirements in terms of collateral, but for $25,000 and less, it is pretty flexible. There are some cons. We are considered a last resort lender. We actually partner with banks in the area because we're not competition to them. Our goal is to help people who aren't bankable to become bankable. And so people come to us who got turned down by the bank, and we often recommend that they go to the bank first because you'll get a better interest rate and better terms. We take a little bit more risk, so we're going to have a higher interest rate. But if you haven't done that, a lot of times we'll send you back to the bank if we feel like there's a deal there. Or if you haven't looked into the possibility of taking out a second mortgage on your home, if you have some equity in it, those are other options. And so we want to help the people who authentically aren't able to get a bank loan. We do have a limited loan amount. Like I said, our maximum is $50,000. And so if you need $100 or $120 or $150,000 to start the business, we probably can't help you unless you already have the other funds lined up somehow. We do have a little bit higher interest rate than a bank. At this point, our interest rates, if you are a business that's been around for a year or more, we're Wall Street Journal Prime plus 5%. So that's 8.25%. If you're a startup, we're around 10.25% right now. And then that's usually a 5-year term. When we get more SBA funding, we can bump that to 6 years. So that's kind of where we're at with it. I might have another slide that talks about that. So limited term, most loans are 5 years. When we get more SBA funding, then we'll be able to bump it to 6 years. And then there are regulations on use. We are pretty strict about how you're able to use the funds. And so we have a use of funds sheet that you're able to go through and list, hey, here's what we need it for. But we do kind of try and keep to that pretty strictly. And then we don't finance product development. So if you have a product that you're working on developing that isn't quite ready to take to market, we probably can't help you, but we would love to take a look at it when you've jumped in and you're ready to go and start selling. Okay, we're going to talk a little bit about other options, and then we'll jump back into the microloans for a few minutes. So a lot of times, when I was with the SBDC, I get a lot of calls that said, oh, do you guys have any grants? Do you guys offer any grants, free money that I don't have to pay back? And more often than not, the answer is no. But sometimes there are options. There are nonprofits out there that can help businesses with grants. State and local governments sometimes have funds that they're supposed to be using in more rural areas or in specific industries to help boost those industries. And so there are places that you can go to look for these, but generally speaking, we don't really deal with those, and they're kind of hard to come by. And sometimes you have to jump through so many hoops to get the funds that it's not necessarily worth it. And then there are some refugee organizations that have grants and loans and things like that. In addition to that, there are some online minority business grants, but you have to be so careful. There are a lot of websites out there that are just trying to take your information. And so I would say be very careful with these and try and find legitimate organizations that are offering these grants and loans, things like that. So let's talk a little bit more about us. We're a nonprofit lending institution. We provide loans and loan support throughout the state of Utah. So we don't do loans for businesses that are located outside of Utah. They have to be here. And like I said, we're a lender of last resort. Here's kind of a picture of some of the logos of some of the businesses that we've worked with over the past. Tony Burgers, if you've been in Salt Lake area, you may have seen these. A lot of little restaurants. We've worked with pet food suppliers. There's a barber shop, Jed's Barber Shop, that I actually got my hair cut from this last week. Big Daddy Hill's barbecue sauce. So we do everything, all sorts of industries. We don't just do one industry in particular, and there aren't a whole lot of industries that we don't work in. So there are a lot of options. So let me talk a little bit about what we are looking for in terms of the loan application. One of the cool things is we're flexible enough. We're not regulated like a bank, and so we are able to kind of look past some of the things that they can't. If you have credit issues, if you have a bankruptcy in your history, if you have maybe some legal issues in your past, we're able to look past that and really look at the big picture. So here's what we're looking for. Writing a good business plan is extremely important. We want to know that you have a sound understanding of your business and what it's going to take to run it. And I'm not going to talk too much about this because the SBDCs are better at it than I am. There are 3 things that I'm looking at when I go through these loans. I'm looking at your operations. What are you selling? What do you need to sell it? And how are you going to do it? I want to see that you have a structure for how this business is going to run. Marketing. Who are you selling to and how are you going to reach them? It's important to have a strong competitive advantage and really have a sound understanding of who your competition is, whether that's direct or indirect competition, and knowing how you're really going to reach your market. And this doesn't necessarily have to be extremely sophisticated. We don't have to see, oh, we're going to do Facebook ads or pay-per-click ads. Sometimes it's, well, we're on a main highway and we are just going to put our sign up and we're one of 7 restaurants in the area or whatever it is. That's great. That's good enough. That's going to help make people aware of you and come to you. And then financials. How much do you need to start the business and how much do you need to cover your costs? Financial projections are extremely important and I want to know that you understand your numbers. So let's talk about financial projections. How are you going to use the funds? A lot of times when people hear that we offer up to $50,000, they swing for the fence and they decide I need $50,000 to start my business. And that isn't necessarily the case. Sometimes that's even detrimental to them getting approved because we do look at those a little bit more closely in terms of how we're going to get paid back if the business fails. And so if you could make $25,000 work and you're asking for 50, we could say no, or we could maybe say, hey, we've approved 25,000 or 30,000. And so you may not get the complete ask, but I would say it's better to go in with a sound understanding of how much you are going to need. And a lot of that comes from what you're going to use the funding for. And so that's something that you definitely want to sit down with your SBDC counselor and go through in depth. How are you going to pay it back? Unfortunately, that's a big thing in the back of our minds is how is this person going to pay us back? We're a nonprofit and our goal is to make as many people successful as possible. And if we don't get our funds back, we're not able to lend it out to somebody else. And so there has to be a sound plan for how that's going to get paid back. And then what impact will the loan have on your business? If we look at it and say, you don't really need this loan in order to start or grow your business, then we might say, hey, come back in 6 months once you've gotten going, and then we'll talk and see if it's something that you need. And so it should have a significant impact on your business and how you're able to grow it. So those are really the things that we're looking for, the business plan, the cash flow projections. Those are really key in us deciding whether or not to approve a loan. And then there are lots of resources for business planning. Luckily, you have one in the room or in the building with you. The SBDC is probably one of our strongest partners in helping with that. And so we definitely recommend that you have someone to help you with the planning and someone to really mentor you in helping you grow your business. It's really, I went to school for business, but when I was running a business, I needed someone to tell me the things that I would tell other people. And just having that support system is extremely valuable. Okay, let's talk about you. What are we looking for? Passion, clarity, integrity, and credit. So we go through a lot of these things. Like I said, because we're not regulated like a bank, we're able to look at character as well. And we look at that through a number of different ways. Our interactions with you, we look at your credit, we look at a lot of things, and it's important that you show that you have these things and that we're able to see that. So let's talk a little bit about credit. Credit is a huge challenge for a lot of people. And sometimes we make mistakes, sometimes we miss payments, and that is definitely a challenge. And we look at that, we look at the history. Sometimes if someone has a negative credit history, we ask them to give us a little bit more of an explanation on it so that we can understand it a little bit more. Was it an inability to pay, or was it a lack of willingness to pay in some situations? And so when it comes to creating a good credit score, it's important that you make your payments on time. Keeping your balance low, below 50%, is important. And then if you look at this, these are the things that that FICO is looking for in terms of how they rank you. And so part of it is the payment history, but also it's making sure that you are in a good place financially and not overextending yourself.
Hey, Brandon, I have a question that's coming in, and it has to relate to COVID.
Okay.
They have a great credit score up until COVID hit, and then once COVID hit, due to shutdowns and different things like that, it was massively impacted. So they have perfect credit score up until 2020 hit, and now they're rebuilding from that. How is that going to affect their ability? Because they've already been turned down by the banks. How is that going to affect their ability at this point?
So that's a great question. And that's something that, like I said, we understand happens. One of the things we're going to ask is, what have you done to mitigate this as much as possible? And that doesn't necessarily mean we understand that, hey, I couldn't make the payments. One of the important things to do when you have issues like this is to try and negotiate with your creditors the best you can. We have people who have had to shut down their businesses completely. And so what we've been able to do is be flexible enough with people who come to us and say, hey, we're having issues, and we get them on a payment plan. How much can you afford? Let's do $50. Let's do $100. Let's do $20 per month until you can actually get things going again. And so what we want to see, if there are issues, is what have you done to help with this? And ideal as well, I've talked to them, I'm on a payment plan with them, we've been making minimum payments or whatever it may be. And so if it's something that, hey, we just didn't talk to them and we couldn't pay, and so we didn't communicate, that could get a little bit difficult in terms of the overall picture. And so I would say, if you are in that situation and you haven't done it already, I would contact any creditors that you have and see if you're able to negotiate with them, because a lot of these organizations are able to negotiate a little bit more than we assumed they would. And honestly, that's a tough conversation to have, to call someone. But given how things are economically, a lot of organizations would much rather that you pay them a little bit at a time, or something like that, and just let them know we want to pay you back, because that's part of the livelihood that they're, that's part of their business and their success as well. And so for us, I would much rather someone paid me $10 a month than I had to write it off or send it to collections or something like that. Does that answer the question?
I think so. Yeah, that's something that I have advocated to both businesses and individuals, is to make that communication. They understand pandemic is happening, things like that. Communicate with them. I can't pay this, but I can pay $10 or whatever that is, so that they have that communication, and it makes a big difference.
And yep. And that's part of the character that we're looking for as well, because if someone if the business is struggling and they can't make their payments, we can maybe help. And so if our borrower is too embarrassed to talk to us about the fact that they're having issues until it's too late, then there's nothing we can do about it. And so if they're really showing that initiative, then that really is a positive thing, even more so than if they didn't have issues, because we know, hey, if there are issues, they're going to handle it in a way that's beneficial for us.
Exactly. Then there's another question on the finance side. So, yep. And this is probably directly to something that I've said, because this comes from one of my people. So when I have them go do their finances for the business, especially as a startup, I have them go through and figure out how much it's going to take them to survive for 1 year, because they've still got to pay their bills. They still got to feed their family and pay their own rent, stuff like that. And I have them include that in their startup costs. Is that something you're looking for? Is that something that you don't want to see on there? Because I think that they're concerned that that's too high. Is it supposed to be labeled somewhere? What's the feelings on including personal income, salary in those startup costs?
So you need to be very careful with this, because if I see that you're paying, you have a rent section and you're paying your house's rent in the cash flow projection sheet, that's definitely a red flag, because there has to be some sort of separation between the business expenses and the personal expenses. And so it's important, especially if you're running the business and you don't have another job, that you are getting the cash flow that you need in there. And so in terms of the cash flow projection sheet, I do want to see that you have a certain number, that you've put in a number for your personal expenses. But be careful with use of funds where you're saying, I'm doing a year of rent, I'm borrowing enough money for a year of rent, because we also want this business to be cash flowing. And so two things, actually, two thoughts. So the first thought is, it is hard for any lender to lend money that you're earmarking to pay yourself, because we're not a personal lender, we're a business lender. But there are ways around that where, hey, we're covering, we're covering the equipment purchase, we're covering the rent for our building, we're covering our insurance, things that are more easily trackable, or for payroll or things like that. And so when you start a business, ideally it starts cash flowing and you start getting some cash into it. And really, a chunk of cash is a chunk of cash. You can take this chunk of cash and put it towards paying yourself, or you can take this chunk of cash and pay yourself. And so I would say, when you're filling this out, make sure that everything looks like, hey, everything is going specifically or being earmarked towards business expenses. But and then if you are bringing any cash flow in from the business, then that's what you're paying yourself with. Hopefully that's helpful. So I would say be careful with that. If you're doing 6 months of rent, that can be a red flag, because we want the business to be able to be paying for itself. And so
I usually have them do it as a salary for themselves, or as a payroll, because for them to take home every month or what, so they know the minimum they have to take home is this, and that needs to be planned into their payroll. Okay. Is that incorrect?
So I would say in the cash flow projection sheet, you should definitely put that in there. But be careful. So we have a sheet where you list, hey, here's how much money I'm trying to borrow, here's what I'm going to use it for. I would say just be very careful on that sheet with, 30,000 for my salary. Like just put it under payroll, and especially if you're the one running the operations of the business, then there's a little bit of leeway there. But I'd say just be cautious with that, so it doesn't look like you're just taking out a loan for money that you can live on. All right. So great questions, by the way. Are there any others?
There's a question that I thought about as you were talking about location. So down here in the Four Corners area, we have a lot of businesses that have, like, for example, I've got a Native American Navajo basket making business that we're in the process of putting her into an LLC. And she has a home in Blanding and then she also goes to Navajo Nation and makes baskets, and she's registered under Navajo Nation as a business as well. So how would that fall under?
That's a good question. I would say we would be very flexible with that. I actually haven't had that experience in my 2 years with Utah Microloan Fund, but I would say if it's within, or it's some of it at least is within the borders of the state of Utah, then we would probably be able to do it.
So we have at least one address. Like, we have a touring company, for example, that has a land lease on Navajo Nation, but his physical address is in Blanding.
Yeah, that would work.
As long as we've got that, we can, okay.
Yeah, we'd love to be flexible with those. Those are great opportunities.
With that, we've got some fun businesses down here. It's exciting.
Good, yeah, I know. And maybe with all this Bears Ears stuff, there might be some opportunity for more in the near future.
That's what we're crossing our fingers for. I know you already addressed this, but I know that this is a big concern. We get a lot of lenders that say we don't lend to the hospitality industry.
Okay.
That's on banking regulations and things like that. And it sounds like that's not as much of a concern with the microloans.
So we do lend to the hospitality industry, but as is expected, we are very cautious right now. One of our current temporary requirements is that you create a plan for how you're going to be successful during the pandemic with COVID-19 issues and challenges. And so if you have a strong argument for how your business is going to be successful despite the challenges that COVID-19 is posing for the hospitality industry, then we're definitely willing to look at it. But yeah, I would say it definitely is a challenge right now, for sure.
Very much so. And then do you, as far as microloans, if they're buying out a business, is that an option?
Absolutely. Yep. We do business purchases. If you're getting a good business for less than $50,000, you're getting a great deal. But definitely we'd want to see the financials. We'd want to see some sort of, written agreement eventually. But we just did a recent business purchase the other day, a mechanic shop, and yeah, we're happy to take a look at those and see what we can do to help out with them.
Very, very cool.
Okay, I think I have a couple more slides unless you want to.
No, I was going to say that's all the questions that I have that have come in as you've been talking. So
okay, cool. Yeah, great questions. All right, so we're going to talk about what happens if you don't get the loan. If my slide will change. Okay. Sometimes we're not able to help with a business, and it breaks my heart especially. I'm not the one who decides whether or not you are approved. I'm the one who kind of advocates for you to get you approved. And unfortunately, we're not able to finance everyone. If you don't get the loan, what happens next? I like to ask this question: can you bootstrap the business and start it anyway? Is there any way that you can show that you're going to do this regardless? If you came back 6 months after a decline and said, hey, I started it anyways, I have a little bit of sales, I have this interest, and this is the progress I've made, people are a lot more willing to look at that and see what they can do to get you some financing. So don't get discouraged if you're not able to get the financing initially. We're willing to look at people and their businesses a second time as well. So, and when it comes down to it, always borrow money from a pessimist because he won't expect it back. So those are all my slides. There was one other thing I wanted to mention, but I don't remember it anymore. Oh, I think you're muted, Megan.
I was. They're doing construction here, so I'm trying to avoid the noise coming in. So I had another question come in. It says, what if people have done other funding options and a microloan would be a way to lower their interest rate and consolidate their payments? Is that a way they can use this?
Yep, we will consolidate payments. We do want to see that the business is successful. One of the challenges, sometimes people get themselves into trouble financially, and we can help with that, but it isn't always a guarantee. So you're welcome to apply. Oh, there was one thing that I wanted to show you. We've got a little bit of time still, right? All right, let me close this. And I will show you. So we just added an online application process. And so the process to getting a loan with us is you would go online and there's an orientation slide deck. We're actually changing it over the weekend. So right now it's a little outdated. I could send Megan the updated one to send out to all of you. But once you've gone through that, there's a form online that you fill out to request access to our online system. And I just wanted to walk you through our system quickly so that you could get an idea of what the application process is going to look like. So it's called LenderFit. So we will basically give you access to this, and you go through all of this and fill out the information. So we want to know some information about your business, and so you would go in and you would fill out a form, you know, the date, stuff about your business, a little bit of a description, and you would go through and give us as much information as you could. So you'll go through that, your ownership information. We do ask for a personal financial statement. So business plan is required, cash flow projection sheets, but then we're looking at the last 3 months of your checking account history. We're looking at the last 3 years of your financials. We're going to pull your credit like a bank does. So we're very similar to a bank in that, but like I said, we're able to be a little bit more flexible. So you would go down and you would fill out, or you would upload everything that's on the list if it's applicable. If you're a startup, then you don't have to give us a profit and loss, obviously, but you'd fill it out, and then we would go through it and check it off when it was done, and we would ask you questions. And I would highly recommend, if you do decide to go through this process, that you're as transparent as possible, and try to be as accurate as you can, especially when it comes to personal financials, how much you're making, and if you do have any assets that you're able to use as collateral. So you'll go through this, you'll fill everything out so that we have access to it, and then we'll go through it. We'll ask questions if we have any, and then we'll get you scheduled to meet with the credit committee. So the cool thing about getting a loan with us is you actually get to meet with the credit committee. And I love that, because when you look at a business on paper, it doesn't always look the best or look ideal. But when you get to know the person and you see their passion for the business, and you see that they understand what it's going to take to grow that business, and they're willing to work hard to make it work, there are a lot of initial no's that turn into yeses. And so, we want you to be successful. Sometimes the way that we can help you be more successful is by saying no, unfortunately. But if we can say yes and we can help you be successful, we're definitely going to do it. So I would love for any other questions if you have them, and I'd also love to chat through email or on the phone to give you more information about our program. But hopefully we'll see more of you. I'd love to get some more money down to Blanding and Price and Moab areas so that we can help you guys grow your businesses. I think there's a lot of opportunity in these areas in the near future for starting and growing businesses. So let's see what we can do to get that going.
Are those committee meetings done over Zoom, or do they need to plan a trip to Salt Lake?
Nope, they're all done through Zoom. I wish you could send us free samples of your food if that's what you're doing still, but unfortunately that's not the case. Yep, so we do a Zoom call. We do 2 Thursday afternoons per month, and basically the deadlines are on our website so that you know when you have to have your application in and things like that.
There you go. How long's the turnaround time for a microloan? Is it like 6 weeks, 2 months? Is there a kind of a standard timetable for that?
So it's usually 3 or 4 weeks. If you get it in by the deadline, so let me give you the process. So we need 2 weeks to go through it, and we have deadlines for. So basically, if you get it in 2 weeks before our next credit committee meeting, then I have a week to go through it and ask for more information or ask questions. And then I send it to the credit committee. They have a week to go through it, and then you meet with them. So it could be as short as 2 weeks. Once we go through that and you go through the credit committee, we'll let you know the following day whether or not you were approved or declined. And usually the following week, we can get you the funds. And so plan for 3 or 4 weeks most of the time.
Very cool. Very cool. Well, are there any other questions before we close out? I think that they were pretty good about sending questions through as they were coming up. So that was really great. We really appreciate the time that you took to go through. We're getting several hearts come across. I don't know if you can see those or not. And I'm getting a lot of messages we've got 2 platforms running here. So I'm getting a lot of messages saying that it's great information.
Good.
So we really appreciate you taking time out of your schedule. I know that you've got a busy schedule to help us out, and I look forward to referring and utilizing Utah Microloans as we move forward, because we've got several businesses that are right in that perfect spot for
Awesome.
utilizing these. And so I'm really excited to have that service and be able to utilize that. So we
Great.
appreciate you taking the time. For those that are watching the replay, if you have any questions, feel free to comment or go ahead and contact us here at the Small Business Development Center at any of the 3 locations that we've mentioned here. And we look forward to working with you in the future. You guys have a wonderful evening, and thanks for joining us. Bye-bye.